Session there with Larry Shover, Chief Investment Officer at SFG Alternatives. Larry, thanks so much for your time. Let's talk earnings season because that's what kicks off today with Alcoa. Not long till those results are officially out. What are you looking for in Alcoa, which is set to set the tone, I guess, for Q4?
Well, you know, Alcoa will set the tone, although I think the expectations are so low right now. They've been dialed down that anything will be better than nothing. Let's keep in mind that 65% of Alcoa's business is really downstream, and that's something that's suffered and is priced into the stock right now in U.S. terms, trading about $9 a share. Upstream is the aluminum price. I happen to be short-term bearish on aluminum right now, given the vast amount of stockpiles and that the business cycle just doesn't have the demand right now. So with that in mind, I think they might meet expectations. They might even beat expectations, earnings per share. However, the market's expecting something much bigger than that for earnings to go forward from here. Alcoa, a very small microcosm of the market.
Yeah, when we look at output, they've reduced that. They're also looking at cutting costs. They're managing, if you like, the perceived slowdown. Do you think that they're doing well strategically at the moment? Is it a story you like?
You know, right now at $9 a share, it's not a story that I like because I don't have a hold rating. I either have a buy rating or a sell rating. I like the stock at $8 a share, but not at $9 a share. I mean, it's like, you know, almost 10% away. And we can see that, especially as we see aluminum stockpiles continue to grow. We're not sure if it's all financing deals or what, but I do think, to answer your question, Alcoa is doing a wonderful job, a splendid job in trying to cut costs and trying to get rid of some of their losing businesses. They sold a hydropower plant in Tennessee not too long ago. But the fact remains they're burdened with debt. They have $8 billion of debt, and aluminum is not going anywhere quick right now.
Okay, let's look more broadly. Earnings season, it's been pretty stagnant for the past 4 quarters. Expectations are low this time around. Do you think the bar is set about right?
Yeah, you know, I think the bar is set about right because keep in mind that the earnings per share expectations for the broad market, the S&P 500, is almost 10% back in October. It's been dialed down to almost 3%. So the bar is set so low right now that I do believe that most stocks will exceed expectations, but I think it's bigger than that. I think people are looking beyond that and looking at a bigger catalyst down the road, and it's not earnings right now.
Larry, good morning or good afternoon your time. It's Martin Lakos here. I'm interested that you mentioned about the broad dialing down of earnings expectations, and yet we've seen this PE expansion in the broader market. Look how the US S&P has rallied so strongly. So, you know, where are we in terms of market levels? Do you think that there's a lot of room for disappointment, or do you think the S&P's priced at about right on that 3% earnings growth number?
I think it's priced correctly right now. However, my underwhelming or underlying theme to that, Martin, is that stocks are fundamentally cheap. I mean, yeah, we have a 12 times, a 13 times earnings outlook. That's how stocks are being measured right now. But with that in mind, stocks definitely are on the cheap side of history, and I do believe that by the end of the year we will see at least a 10% rally in the S&P 500. Although, as we all know, there's some significant headwinds in the way, at least in the first quarter. But I think we're going to surprise a lot of people, and the S&P 500 will see a 10% rally by year end.
Do you think we'll see a breather before then, though, a correction in the near term?
Yeah, absolutely. And we're sitting on a very key support right now at 1450. I mean, I could see us trading down to 13 times earnings per share, which would get us down to about 1350 in the S&P 500. But right now, we can absorb a lot of negative shocks, and getting down to 1350 would be a tall task. So, yeah, we can see it. We will. I'm not saying we will. We could very well see a correction. However, I do think the pain trade is going to be higher. It's going to be really hard to get on board, but that's the way the stock market has been over the last 12 to 18 months. And
of course, central to this discussion is quantitative easing 3. We saw those, what most people said were a more hawkish statement from the US Federal Reserve at the start of the year. Do you see QE3 ending this year?
I personally do not see QE3 ending this year. I think they're going to keep their foot on the gas pedal, along with the whole world doing the same thing. I mean, I think that was a little bit of a shock headline. When you have 3 economists, you're going to have 3 different opinions. So therefore, you're going to have somebody who's going to be overtly against what the majority wants. However, unless we see inflation peak its ugly head, I just don't see it happening. I think the gas pedal is going to be down for the next year and a half to come.
Larry, if I was an investor, or I am an investor, I guess to some extent looking outside of the United States, looking in, what are the two key sectors or thematics that you're looking at for this year for investors?
For me, I prefer financials and materials, especially over something like utilities or energy. And my reason really is just the tailwind that we're seeing in the housing recovery. I still think the market's underappreciating how much of a tailwind that's going to be. Now, to be honest, the housing recovery is not going to have the same effect on GDP that it had maybe 5 years ago, but it's going to have a domino effect. So I really still like financials, materials.
Okay, more talk about this Treasury appointment in the United States as well, and the media continues to point to Jack Lew as being the lead candidate. What do the markets make of him?
Well, I think the market's pricing in that he's going to be the next person in charge of the Treasury, and as you can see behind me, there's not a whole lot going on right now except for a lot of consolidation and digestion. So unless it's somebody else that nobody's heard of, I think the market's pricing it in that he's going to be the next guy.
Larry, how does the market price that in?
Well, the market prices it in by not going down. I mean, the fact that we've gone down a little bit today, but we're really just consolidating that big move we had January the 2nd. I mean, this isn't really a correction. This is more of a consolidation, a digestion. There are some subtle dynamics in the market where you're seeing a lot of fast money sell stocks right away and taking quick profits. But the underlying change that we're seeing is that stronger hands right now are being a lot more selective. So we're seeing correlations in the stock market break down a little bit. And as you know, that correlations were very, very high towards the end of 2012. So I think strong hands, deep pockets are being a lot more selective with the stock market right now.
Okay, great, Larry. Thanks so much for checking in with us. Larry Shover from Chicago.